Okay, ladies and gentlemen, and welcome to the EI Inventories Prep. If you are joining me from the CPI release data that we had earlier on, of course, data came in slightly better than expected, or better than expected overall. Focus on the EI inventories. We've got a lot to cover and to go through. So, what is it? So, the release represents a weekly change in crude, gas, and distillate inventories. And what it affects the most, of course, is transportation. It also affects consumer prices for a number of products too. So remember, we've got to think that crude oil, a lot can be made from it, plastic goods, which the Chinese make a lot of, and also a lot of other products are made using crude too, and also services as well. So if you're going to your gas pump in the US or your petrol station in the UK, similarly in that way, it's going to affect. Of course, if there's more oil that's been created, or if there's less oil being created, it's going to have an effect on the crude oil market there. More so in the short term is why we're focusing on the EI inventories. It can have it can be quite volatile, where we have seen recently and in past events where we've seen about $1.30 move, or about at least $1 move, and sometimes we can even see sometimes even what we had seen before the Russia-Ukraine conflict, about $2, or sometimes that we can see that happen. But just note, so it can be a very volatile trade. Is something to just be aware of. Then, how does it affect the market? So this is the key thing that I think everyone needs to just understand, whether the difference with EI inventories data is that when more oil is added, it is negative for oil prices instead. And then when there is less oil added, then it's more positive for oil. So when there's a build in inventories, usually what that means is that demand is lower. So what companies and businesses will try to do is lower the price, if they've got too many inventories, or built too many inventories, they'll try and lower the price of crude oil to try and attract buyers. And then vice versa, if there's a draw, or if there's less oil added, then that means that demand is quite high and there's less oil available to the markets and also countries as well. So then it becomes more, then we would see more of an appreciation in oil prices. So that's just the very basic way to understand the oil release. And historically, we have seen that reaction in the past as well, where if you have seen a build in oil inventories, you'd see, or if you have seen a build in inventories overall, you'd see more of a negative reaction, or a depreciation in oil prices, and vice versa. So the triggers then for the release for today. So for crude, the high estimate is 2.3 million with a low of -3 million. Gasoline, according to economists, with a high of 1.5 million and a low of -3 million. And then distillate with a low, or with a high estimate of -0.5 million with a low of -3 million. Then API data, something that traders keep an eye out for what could foreshadow what could be the data for the day ahead from the official government release. So API data is a privately owned company that provides this data. Isn't available to the public. So what traders do with the data is, as said, they can use it as a way to see what the crude or the inventories data could be the following day. The reason being is that there has been some correlation in the past between API data and the direction of the EI data that's come out the following day. So that's something that traders do keep an eye out for. There hasn't been a very strong correlation. It doesn't mean that if API is showing a build, let's say in crude oil inventories, or build in gasoline inventories, that the EI data the following day is going to show the same direction. But sometimes there has been some correlation to it in the past. Hence, it's a release that traders focus on. and are very tentative too. So with API data that we've had recently for the past couple of months or so, there hasn't really been a reaction to the release as there has been beforehand. So last week we didn't see a reaction to yesterday or last night we didn't see a reaction to API data. Although the figure came in at a build of 1.618 million compared to the forecast of minus, it came in, so forecast was for a build. Data did come in at a build of 1.618 million compared to the prior of minus 3.497 million. Again, markets didn't react to that release as they usually would have prior to the Ukraine-Russia conflict. And then API gasoline stock change actual came out at 0.823 million. So again, a build on the prior of minus 4.5 million. And then if we're looking at the other bit of data then, so then the Stillet stock change data came in as a build as well at 0.662 million compared to the prior of minus 4.457 million. So a build overall in the API data. Does that mean that today's data is going to show a build as well? Well, that's yet to be seen. As said, there isn't a strong correlation between API data or EIA, but as said, it is something. It is a set of releases that traders do focus on and try to gauge what the EIA data is going to be for the following day. One thing I want to show as well, if we look at the current or the median forecast, then according to economists, where they see EIA inventories. So the headline figure, crude oil inventories forecast is for a draw of minus 1.45 million compared to the prior of 1.302 million. Gasoline inventories expecting a build of minus forecast of minus 1.6 million compared to the prior of minus 2.230 million, and still with a build forecasted as well at minus 1 million compared to the prior of 2.344 million. So just to be aware of that there, I'll just show you that there as well. But that's there for you. Okay. So moving on then. So what's driving the sentiment at the moment? So WTI option skews turn bearish. Well, we have a lot of there's actually more there's more people or traders that are selling WTI options instead. We've also got Saudi Energy Minister Abdulaziz, oil minister, saying that all energy sectors are running out of capacity. So the other part of the sentiment then. So this is the key thing that's been driving the oil markets since the beginning of the week and from Sunday night. Is the key thing is that you had a Saudi Aramco that had decided to cut oil prices for a lot of nations and continents as well. So in northwestern Europe, Saudis cut light crude by $2.50, and they cut light crude for Asia by $4.95, and the US was left unchanged at $7 a barrel for light crude. So we've got to bear in mind that the last 2 months, Aramco had been prices were raised as oil hovered around $100. We are still at above $100 on WTI. I think if I zoom out then, and we'll show you what if I go back to on a higher time frame, I'm going to show you what happened from the weekend when we had that news from Saudi Aramco, and then the reaction to today. So if we zoom a bit more, there we go. Okay, so off of the back of Saudis cutting prices for majority of continents, barring the US, we had seen this negative reaction, or bearish reaction where WTI crude oil prices had seen a depreciation. Of course, one of the factors that is driving or that caused the Saudis or Saudi Aramco to cut its prices for light crude for northwestern Europe and Asia. One, for Asia, with China and their COVID lockdowns and restrictions, that is having an impact on productivity, where the factories that usually are they were open and running in Shanghai, they and also in areas and demand for oil in Beijing, in the city of Beijing, China overall, was seen to be there was a demand slip, or there wasn't that much demand from China for crude oil because of the lockdown. So you've got to remember, when a country goes into lockdown mode, the demand for oil also falls off too, or sees a depreciation. And what happens there is that if there is a lot of oil that is in the markets or that is being provided, but there isn't the demand for it, oil prices, as we'd seen, decide to go down instead. So at the moment, we're up by $6. We're up by 6%. Excuse me. So up about by 6% on the day so far. Just to note there what the current market reaction is. But we've had a lot of selling since the beginning of the week, so a bit of a reversal there. Seems again, it could be because of the reversal of the earlier surge towards the downside that we're seeing this current move in WTI crude oil. But that was one of the bits of sentiment that was was driving the markets at the beginning of the week, and still overall having an impact on the crude oil market. So as said, you have China lockdown, and the other reason for this volatile trading in the oil markets as well is of the Russia uncertainty. Okay, so the Russia uncertainty, of course, with one of the things you've got to bear in mind is that you had Russian exports that have fallen of WTI crude oil, and on top of that, you have the European Union that is looking to ban Russian energy or Russian oil quite soon. So you had von der Leyen looking to ban Russian energy altogether by the end of the year and start with crude and to try and phase that out by 6 months. So that's also had added to some positive pressure or bullish pressure towards the upside on WTI crude oil in the previous week. Still something that has been commented on, and there's a lot of comments going around with the European Union as to what to do or how long it'll take to phase out Russian energy. But the other bigger driver that, as said, had come in at the beginning of the week, or on the Sunday during the day, was that the Saudis had decided to cut oil prices for majority of nations. That's quite key to understand, that if the Saudis aren't confident that there is enough buying of their oil, then that could mean that there is less confidence. So in other OPEC nations as well, in those nations having their oil being exported to other nations that rely on them. So I think that there's two bits of sentiment then that are mixed together. As said, the Saudis were the bigger driver of the market so far this week, and then you had the EU and the Russian uncertainty that creeped in as well. So just bearing in mind with the China lockdown too, so it was the largest demand shock since the early days of the pandemic in 2020. And also consumption of gasoline, diesel, and aviation fuel last month was expected to slide 20% from a year earlier in China. So again, Saudis reducing their oil prices in waiting for this loss of demand, or already there is a loss of demand from China, and what could mean that for Asia overall. Again, that's something to consider. I just understand as to why the Saudis or Aramco had decided to cut their oil prices. One thing to bear in mind, though, is that the oil price cut for Asia, according to some traders, that they were expecting, oil traders, that they were expecting about a $5 cut in light oil crude prices for Asia. So near enough, it matched. It was near enough met expectations only by 5 cents. Was the difference, but even then, the markets had that reaction or negative reaction in WTI crude oil. And then other stuff as well. As I said, it will be the first time in 4 months as well that the Saudis have decided to reduce the price for crude oil, light crude oil as well, for Asia. So just to bear that in mind. So more so in regards to the price cuts then. So this is just from Bloomberg, from online, a little piece that I'd found that showed the price of light Arab crude oil. So you could see that during the COVID pandemic, that was in the minuses or in the negatives, and then as the global economy recovered, then it picked up. We reached a peak of around $10 a barrel. If I remember, the last price that we had seen was around $9, or $9 and around $9 for Asia per barrel. But this is showing that now that there is, first of all, that there is uncertainty with Russian oil supply, whether or not, if we have seen Russian energy or Russian exports decline, and the Saudis are having to, or other OPEC nations are having to make more of that, make up more of that, then I think one of the things that we're going to consider is that from the OPEC meeting that we had last time, is that they were very reluctant to raise the amounts of output of crude, or raise the output of oil being pumped into the markets. So it currently is around 432,000 barrels per day that the OPEC Plus is adding to the markets. But one thing I think we've got to understand is that with the EU and the US asking OPEC to raise that output, that the Saudis have been quite key in saying no, there isn't a need to do that, and so has OPEC General Secretary Barkindo, saying that the shock in the oil markets is mainly due to do with political events, not the actual supply that there is within the market, or within the oil market itself. So that was the main reason as to why the OPEC Plus didn't raise oil output further. But one way that the Saudis then have kind of counteracted that, or done something else to get around that, instead of raising output, is to make oil prices cheaper for nations. So again, if you think if Saudis were to pump more oil into the markets, then that would definitely, I think, you'd see more of a negative reaction in WTI, where we'd be below, where we could potentially go below $100 a barrel instead. I think with this oil pricing, one, you've got to consider that it's not a huge. It is a bit of a shock to the oil markets, but it wouldn't be as huge as if the Saudis decided to, or OPEC decided to hike output instead. So that's one other thing to keep an eye on there. Okay, so investment bank views then. What are they saying? So you have Rystad Energy's analyst who say that India, which increased its Russian oil imports by 800,000 barrels a day between February and April, as Urals crude was offered at a discount, could buy an additional 300,000 barrels per day, and China could raise out inflows by 200,000 barrels per day. So Russian energy isn't in high demand in the Western Hemisphere. You've got the Indians and Chinese that are looking to make the bulk up of Russian energy. And if there isn't so much of a demand for Russian energy, that means the Russians might have to decrease their prices, what the Indian government has been asking for, in order to keep up, or to try and keep up their exports and not to lose any potential revenue they could get. Also, Rystad Energy says that the estimates are part of a base case scenario in which incremental Russian cargoes can easily increase as customers that typically buy crude on short-term market from areas including West Africa, the North Sea, and the US reshuffle their purchases. Again, move away from Russian energy to other areas instead. Hence, they've been trying to get the Saudis, particularly out of the OPEC nations, to try and ramp up the oil production instead. Of course, for the US, the Saudis are leaving their rates unchanged at $7 a barrel. So we'll see what kind of geopolitical or political conflict that we do get, or if we do get any political conflict between the US and the Saudis, or kind of if they do decide to have, in the extreme case scenario, if they have like a price war going on, or if the US tries to take drastic action. But that's yet to be seen what kind of action or reaction the US has to OPEC. We've got about 9 minutes left of the release. So Monday on the 9th of May, as said, the US benchmark oil prices fell 6% to $103.09 per barrel, which is the largest percentage loss since March 31st. Crude oil is down, according to Miso, due to the Saudis decreasing the official selling price. Again, what I'd hinted at, what I said earlier, as to why we'd seen that depreciation in WTI, which was the highest ever, and demand destruction from China's commodity lockdowns and the 3-year high in the dollar. So there's other bits of sentiment that are weighing in on crude oil as well. So from the Fed tightening, you've had the dollar appreciate by quite a bit in the markets, and that's remember, with a stronger dollar you can buy more crude, and because crude is pegged, because WTI crude oil is measured in dollars. Again, it just means that the stronger the dollar, the weaker the crude oil, the weaker WTI is going to be. And with the CPI data that we received today as well, when we've seen the dollar appreciate, WTI crude oil prices had seen some movement towards the downside as well. So you've got to just bear that in mind as well. So it's not only just the EIA inventories release that is going to have an impact on the market reaction, but also sentiment-wise as to what else has happened in the US in regards to their inflation data. So if we have a look at the previous reaction then from the markets, if I just play the video here for you. So from last week, what we had. So on May 4th, about 3 seconds before the release. So there was a build in the inventories data where we'd seen about 1.3 million in a build compared to the forecast of minus 0.6 million. The other bits of data, gasoline and distillate, had seen a draw, but what we had seen, so even though there was a bigger draw, we'd still seen that market reaction where WTI crude oil had seen a move towards the downside. It wasn't so strong, really. There was about 40-cent move towards the downside, about 50 cents move towards the downside, compared to the other times where we've had the release show a bigger deviation or stronger deviation in compared to the forecast figures with crude oil inventories. So again, last week's data wasn't outstanding, as the markets didn't really react to it that much. But we've also got to consider on that before then, what we had is that we had the European Union saying that they will look to phase out Russian energy or Russian crude by 6 months and refined products by the end of the year. So that was more so weighing on sentiment. Today, we haven't seen anything to do with oil in regards to sentiment. It's mainly been driven by CPI data that we've seen the earlier market reactions, but there isn't anything else to, I think, weighing in sentiment. So that was the market reaction there. If I kind of skip ahead forward. And then we look back, so the reaction again, so there's a bit of a move towards the downside, about 57 ticks, about 57 cents, and then peaked after about a minute, and then moved back towards the upside instead. So if we go to our deviations now, if you're a subscriber to, or if you've signed up to our mailing list for Macro Ace, you'll get to see this deviation or deviation sheet we have in our mailing list on the Sunday night. The reason why I did that is because sometimes I'd found that I didn't have enough time to go through the deviations. But if you are a subscriber, or if you are subscribed to our mailing list, you'll be able to see this on the Sunday, and then make up your own informed decision as to what you want to do. But what we can see is that when there was a 1.9 million deviation from the forecast figure, overall the rest of the data had shown a draw of a similar amount of about, or more so, of about 2 million to the draw side. So there wasn't too much of a difference. The draw side was slightly bigger, but there wasn't a big reaction to the release. So as said, so we'd seen about 57 ticks towards the downside, and then candle, and then after about 10 minutes, it was up by 2 ticks. Peaked after about a minute to the downside, and we'd got about 65 ticks towards the downside there. Got about 4 minutes to the release. So I think what we're looking for in the past as well. So if crude oil data sees a much bigger build or draw compared to the other two figures, then we'd expect more of a stronger positive reaction in the crude oil market. And if there is an overall build in the data, or overall draw in the data, then if there's an overall draw, then we'd expect a stronger movement towards the upside. But if there's an overall build, then vice versa, a stronger move towards the downside. But if the data is mixed, we might get the reaction might not be so strong, and the reaction would only last for what we've seen last time is that there was it lasted for about a minute. Historically, that's what we had seen. I think also, so just to go over that again, so if the headline data is much bigger, or there's a bigger deviation, bigger difference compared to the other figures, then we'd expect to move in the direction, expect to see a stronger move in the direction that the data is showing us, whether it's a build or a draw. But if the other two bits of data together are showing a different, if they're showing a different move, i.e. if they're showing a build compared to a draw, then, and if it's bigger than the headline figure, or much bigger than the headline figure, I think we'll look for at least, from what we've seen here, there was about 2 million deviation here last week from what we'd seen, enough for it to see this sort of a reaction here with 50 ticks up and 89 ticks after about 10 minutes. Then that's what we've got to, and that's one thing to expect. So we could see similar reaction here, i.e. if we do see a build overall in the other bits of data, we could see a move towards the downside or depreciation. So we've got about less than a minute left till the release. Let's get tick strike up and running too. About 37 seconds. Okay. All right, so we'll see if the data is, if all the bits of data are more or less in line. If all the bits of data are moving in one direction, then I'd expect maybe a stronger reaction, whether it's a build or a draw. But if there's a mixed bits of data, then we're gonna probably get more of a mixed reaction. Markets. About 10 seconds to go then. Okay, build of 8 spot 487 million, a build there compared to the forecast of minus 1.45 million. Gasoline inventories minus 3.607 million. A draw on the forecast of minus 1.6 million. And EI distillate inventories a build as well of minus 0.913 million. So a bigger build there overall from the EI data. Let me get my deviations and check. So so the headline figure then on crude oil inventories data, so deviation to be, so it's about 10 million deviation on the headline figure. Gasoline inventories, let's have a look there. Okay, so that was a quick flash release. So there was a little bit of movement towards the movement towards the downside. Okay, so about 45 ticks towards the downside initially, and then it decided to reverse, go back up, and then on that candle, it's about 28 ticks up there. I'm starting in the deviation, so if I am quiet, then that's the reason why. Okay, so there's a 2 million deviation on the gasoline inventories and distillate. Okay. That's about 0.087 million. Well, that looks to be about, it doesn't really look like a lot, to be honest. From the figures, so about, yeah, but that's about 800,000. Excuse me, about 80,000. Or about, yeah, 80,000 deviation. Or 87,000 is what I have here. So bigger build overall. Market reaction wasn't strong. I think it's more so if we're keeping an eye out on the oil markets, see where they are. Already it was up. It was up by 5.8. It is up by 5.8%. It was up by around 6%. So that could be the reason as to why we didn't get too much of a reaction. If we're more sentiment driven, with the Russia uncertainty and the EU looking to ban Russian oil. So that could be the reason as to why. I mean, although there wasn't any new bits of news today that was really driving the oil markets, that sentiment could still be there then, with a mix of China lockdowns, Russia uncertainty, and the EU looking to ban their energy, looking to ban energy from Russia. That could be, and could be weighing in on markets here, not seeing too much reaction there overall. So overall, there was a bigger build, as said, headline figure seen about 10.3 million deviation from the forecast figure. So there was basically this release just become null and void again. So we'll, yeah, that's the reaction there. If anyone has any questions or thoughts, or anything that they want to add, then do let me know in the chat or in the comment section. Also, bearing in mind with financial juice, so you had data and headlines then on why we want to keep an eye on what's going on. Ooh. So glitching there, I'll kind of minimize that. On why we want to keep an eye out on what's going on in the. All right, I'll keep it there. What's going on in the markets? So the headline here. If I show you an example If we bring it up, von der Leyen. So, one thing I want to show here then is with the... Whoa, that's not liking at all. Sorry, guys. Hold on. Okay. So, having a Squawk service or live voice and text feed is very key for traders. The reason being, one of the reasons why it's important is that this is the level that investment banks have when looking at the markets. They listen to the news because that's the main driver of what happens within the markets, as we've seen with the Saudis. Okay, with them cutting the official selling prices for a lot of countries and continents, that had caused a move towards or depreciation in the crude oil market. Again, a bit of news that we put out, although that was on the Sunday. Again, news is key and has always shown to move the markets whenever there is something that goes on. So one example I want to show you here, and I don't think you're going to be able to see it clearly. Actually, you are going to be able to see it clearly today. Hey, there we go. So one example I want to show you is this headline that we had here last week, where von der Leyen, on the same day that the Fed was expected to raise their rates by 50 basis points, and von der Leyen saying that we'll phase out Russian supply of crude oil within the next 6 months and refined products by the end of the year. And when the headline had come out, boom, that was the reaction that we had seen. We had seen the movement towards the upside and appreciation in WTI crude oil prices overall. So again, it's key to stay afloat or stay abreast with what's going on within the news, because if you're not sure of why the crude oil market had reacted that way, or maybe why there was a load of selling going on from the weekend and on the Monday after the Saudis had cut their official selling prices, then that's another reason why you should have a Squawk service, or should be listening in or looking at Squawk service to be able to stay up to date with what's going on. Okay, so that's one reason there. Now, Financial Juice Pro. If let me shut down TechStrike for now. Actually, I'll keep it open so we can kind of see what the TechStrike is doing with the oil market. So another reason why one thing that we want to do to provide you guys with is the best experience that we can, and the only way to get that experience of what a live text and voice feed or a Squawk service does, or what we do, is we want to provide you with a 7-day free trial of Financial Juice Pro. Now, why is Financial Juice Pro exciting, and why is it quite good to and why is it very good to have something there? The main reason being is the one with the light version, there is, or the free version, there's a 10-second delay there, and you also get ads in the light version too. And the economic release triggers that we can set here for economic releases that you manually set. If let's say if you're looking at the 10-year note and you're looking for, let's say, the yield to be such and such figure enough for you to buy it, or such and such figure for you to sell it, then you can set that there. And what it'll do is when the release comes out, if it meets your requirements or if it meets your trigger, it will show up with a buy or sell alert there on the side. That's what you can get in the Pro version, which has no delay compared to the compared to the light or free version of Financial Juice Pro. And of course, as said, you get live voice and live text coming through that you can use as well. So you can stay up to date to the second when the news comes out. You can stay up to date with the news that we put out. Okay, so that's Financial Juice there. You have the link there for a 7-day free trial to be able to use. Also, as I mentioned in the previous stream for CPI, if you want to see the deviations and kind of prepare yourself a bit better for release, then sign up to the mailing list. Okay, so not only do I provide the deviations for the releases, but also provide a week ahead of what to expect in the markets and economic release wise and news wise too. So that's something again is for our subscribers for Macro Ace that you can get there by following that link. And also I'll be providing the links to the videos as well in that email as well for you in one place. Okay, so that's Macro Ace. Don't forget to, if you did like this video, if you did find it quite useful, then don't forget to like and subscribe to our channel and share this content that we have again. And also, if you liked our content as well, even more so, then follow us on Twitter as well and keep us, show me the love. Keep the ball rolling. There's quite a lot of useful information that traders themselves have said that they found, and I've even been called the president or to run for president in the US. Who knows? But if people find it useful, traders find it useful, it'd also be good to get some reviews as well of Macro Ace that I can use to kind of showcase for us. Again, you guys matter and what you want to be able to build the service. So Tony at Financial Juice is where you can do that. Tony at financialjuice.com, and send me an email, with your, whoops, I put Juki instead of choose. There we go, Tony at financialjuice.com. So yeah, definitely give me an email and let me know if there's anything you want me to improve or change or add. Then email me there. So, and then finally, Tick Strike. So Tick Strike then. So if you want to listen to order flow or how much, or if you want to listen to how much buying or selling that there is going on, then Tick Strike is the key product to do that. So imagine yourself in the trading pit and all the guys and gals are shouting to buy or sell, and there's a lot of shouting going on. That audio is translated into Tick Strike here. So as we can see, there's some selling going on in crude oil at the moment, and that's being translated here into Tick Strike visually and audibly as well. So don't forget, there's two of those things, two ways you can use Tick Strike there. Bearing in mind, I've of course just shut my sound off for you, so you can't hear it. But you can also change the level of sensitivity too. So if you only want to see or only want to hear when the markets, or if there's a lot of movement or volatility in a particular asset or in the markets, then you can up that sensitivity to 15, where, again, if there's a lot of volatility happening, then it will kind of show up with sound and also visually as well. But if you want to be quite sensitive, or if you want to see more of the market reactions, how it's faring, as we can see now, so just put it to 1, that little move towards the downside that you'd seen there was translated into Tick Strike. So you can keep abreast as to second by second, or see what's going on in the market. Put it 15. Okay, I don't think we're going to get any other reactions there. All right, so Tick Strike. So 7-day free trial of FJ Pro and 7-day free trial of Tick Strike is there as well for you to have a look at. So do feel free. Again, as I said, have a little play with it, see what you think, and provide us with feedback on our software as well. We'll also be bringing out some new software pretty soon too, which combines Tick Strike with unusual activity, if you've come across that. What is the biggest mover within the markets? Okay, not only for stocks, but also for every asset. So currencies, your commodities, as I said, your fixed income too. So, it'll be covering more so of that. But that's something that we will be bringing out hopefully soon. Still it's still something that we are working on to refine and make it great for you guys, as you have a great product. But again, when we do bring that out, do give us your feedback on it. Mateen Suleiman says, how the hell do these experts get the forecast so wrong? Now, actually, this is quite an interesting point of view. One of the lessons or courses that I want to teach you guys later on in the future that I'm building at the moment is how to trade economic releases and how to understand them. So these economists, they're just like you and me. There's human error that comes into play. You go into the doctors and you're sat there in the waiting room, and there are other people there that are looking at you, thinking, okay, maybe his heart pressure is going to be such and such, and all the economists have their different views, whether it's going to be higher or whether it's going to be higher than it previously was or lower than it previously was. And then when you go into the doctors and the doctor checks your blood pressure, and then the doctor gives the data to the economists that are sat in the waiting room, then the figure that they'd expect could be in line with expectations, or it could be completely out of whack, where it could be like what we've seen here, where the actual figure was there was a much bigger build. Actually, there was a build rather than a draw expected instead. So those economists will be rushing around thinking, oh my God, oh no, what have I done? I've got the figure wrong. You then have your investment banks and so on, or those trading oil that might think, got to do something to try and protect my portfolio, protect my trade that I have at the moment in crude oil or whatever it may be. So again, yeah, economists can get figures wrong. It's just down to the data that they look at, and then they make a guess on it, or a professionally informed guess, let's say, to the best of their abilities. On this US EIA crude oil inventories million. I'm not sure what you mean by that. Maybe we're talking about the deviations. All right, ladies and gentlemen, thank you very much for sticking around with me. The figure on the same candle has become a no reaction to the release. The market's kind of carrying on the way that they're carrying on. I think it's still is moved. Well, it's now up by 6.3%. So yeah, markets are carrying on the initial move that they had seen earlier on in the day. All right, thank you very much, ladies and gentlemen, and I will see you next time. There are no other releases that we will be covering this week. All right, goodbye.